Okay, picture this.
Yeah.
A financial firm, right? Just incredibly brilliant, unbelievably confident.
So confident they thought they'd basically beaten risk, like conquered it.
Exactly. Conquered risk itself. A hedge fund run by, well, geniuses, really.
Yeah.
Nobel Prize winners on the team.
Wow.
And they were managing positions worth, get this, over $100 billion.
Yeah.
Promising these amazing, almost guaranteed returns.
Okay, I feel like I know where this is going. Sounds almost too good to be true.
Well, it was. Because then, almost overnight, it felt like poof. It just vanished. Leaving this huge financial earthquake behind. It shook markets all over the world.
It really does sound like one of those old myths, doesn't it? Like Icarus flying too close to the sun, but, on Wall Street.
Yeah, a modern version. But this wasn't a myth. It's the true story of long-term capital management, LTCM.
Right, LTCM. And the lessons from that saga, they're still incredibly relevant today, echoing through finance.
That's what we're doing today. A deep dive into that exact story. We're going to look at the sources, figure out how LTCM climbed so high and why it fell so hard.
And pull out the key insights, the lessons about, brilliance, arrogance.
And the hidden dangers, yeah.
Huh.
What can this story teach you, listening right now, about risk, markets, even just, human nature?
It's such a compelling story about kind of the limits of pure intellect when it slams into the real world, the messy, unpredictable real world.
A reminder that even the absolute smartest people aren't immune to getting humbled by the market.
Definitely not.
Okay, so let's get into it. LTCM. It starts back in 1994. The founder was this guy, John Merriweather.
Ah, Merriweather, a legend from Salomon Brothers, head of bond trading there, right? Famous for hiring these super smart quant types.
Exactly. And he had this idea. Create a hedge fund built purely on brain power, and the team he put together. Wow, it really was a financial dream team.
That's putting it mildly. He got Myron Scholes and Robert Merton on board.
The Nobel Prize winners.
Yep. Actual Nobel laureates in economics. These weren't just random academics. These guys basically invented the tools used to price options. The Black-Scholes-Merton model.
So the absolute top tier of financial theory.
Right. And they, along with Merriweather's other hires, they shared this core belief. They genuinely thought markets were, deep down, rational, understandable, predictable almost.
Okay.
Their whole edge was supposed to be these complex mathematical models designed to, eliminate risk, they thought, and profit from these tiny, tiny pricing glitches. Arbitrage, basically.
But their big assumption, the one that turned out to be, fatal,
was that history was a perfect guide, that past volatility could predict future risk, and that prices, no matter how weird they got for a bit, would always snap back to where the model said they should be. Convergent.
Okay, so convergence, arbitrage. Let's break that down a bit. Their main strategy was finding these slight price differences, yeah.
Exactly. Slight mispricings between really similar things, maybe, like you said, a specific U.S. Treasury bond compared to a related swap.
Or maybe the exact same bond trading for a fractionally different price in London versus New York.
Precisely that kind of thing.
Yeah.
Super complex, often involving derivatives. They'd spot these tiny gaps where prices were momentarily out of sync.
And the bet was just, they'll eventually meet in the middle. Buy the cheap one, sell the expensive one, wait for the gap to close.
You got it. A small, theoretically risk-free profit. The genius was in finding these microscopic differences, like fractions of a basis point, hard to even see.
Okay, but if the profits are that small,
yeah,
how do you actually make serious money?
Well, that is where it gets really interesting and, dangerous. The answer, leverage. Gigantic amounts of leverage.
Gigantic how?
I mean, truly massive. Think about this. For every $1 of their own money, their actual capital, they were borrowing over $25, sometimes more.
Wait, 25 to 1?
Yeah.
Seriously?
Seriously. And often this borrowing wasn't even straightforward loans. It was baked into the derivatives they used. So it let them control these enormous positions, over $100 billion.
With less than $5 billion of their own capital tied up.
Exactly.
Wow. So they weren't just smart bets. They were unbelievably big bets.
Hugely leveraged bets, which, it juices the returns if you're right.
But it magnifies losses like crazy if you're wrong. Even a tiny bit wrong.
Your margin for error just disappears. It's razor thin.
So what gave them the confidence to take on that kind of, insane risk?
It wasn't just cockiness, though there was probably some of that later. It was this deep ingrained belief in their models. They genuinely thought they'd sort of solved risk.
Like it wasn't random anymore.
Yeah, like they weren't gambling, they were doing science, applying proven principles.
Yeah.
And for the first 3 years, I mean, it looked like they were right.
The returns were incredible, weren't they?
Oh, absolutely stellar. Like over 40% a year, consistently. Wall Street, investors, everyone was just throwing money at them, lining up to invest.
You can see how that happens, that kind of success.
Yeah.
It must have felt like validation.
Total validation. And that's where the hubris, the overconfidence really started to creep in.
They started to believe their own hype, that the models weren't just good, they were perfect.
Pretty much. Infallible. Their genius felt like immunity. And that core idea, markets always return to normal, it stopped being a theory and became like an article of faith, a dangerous dogma.
Blinding them to maybe other possibilities.
Exactly. They were betting hard on convergence, on rationality winning out. They kind of discounted the chance of things going really, really wrong, those extreme rare events.
The tail events. The stuff outside the neat bell curve their models relied on.
Precisely. The things history doesn't really prepare you for.
And then 1998 happened.
Yep, 1998. The world didn't just wobble, it felt like it cracked.
There was the Asian financial crisis already bubbling, but the big one, the trigger,
Was Russia. August 1998, Russia defaulted on its government debt.
which nobody saw coming really, or didn't want to see coming.
And that default, combined with the Asian crisis, it just sent the shockwave, an earthquake, like you said earlier. Investors everywhere panicked, fleeing anything that looked even slightly risky. Yep, a massive flight to quality. Everyone rushed into the safest possible assets like U.S. treasuries. Liquidity just dried up everywhere else.
And that was the exact moment their models just broke.
Completely broke. Because instead of those price spreads converging like the models insisted they would,
They blew out, widened like crazy.
exactly. The whole world was doing the opposite of what LTCM needed it to do. Correlations went haywire. Markets they depended on seized up. Their historical data was useless against this kind of global panic.
It was the perfect storm for them. The models just couldn't account for that kind of extreme systemic event.
The black swan event. The thing that's not supposed to happen but does. And it completely blindsided their formulas.
So all those carefully balanced positions betting on convergence,
Yeah.
suddenly they're all going the wrong way at once.
And hemorrhaging money. Not just small losses. We're talking hundreds of millions, then billions, just melting away, day after day.
Okay, so faced with that kind of disaster, what did they do? Did they cut their losses, try to get smaller?
You'd think so, right? That would be the rational thing. But no, their response.
Don't tell me.
They doubled down.
No?
Yes. They bet more. Poured even more money into the same failing trades. Because deep down, they still believed their models had to be right eventually. The market had to be wrong.
Wow. That's belief bordering on delusion.
It was intellectual stubbornness hitting a brick wall of market reality. That incredible leverage that made them rich. Now it was like a ticking bomb. Every loss was amplified exponentially. It became a death sentence.
They were trapped by their own certainty.
Completely. They saw the divergence not as a sign they were wrong, but as an even bigger opportunity because the snapback, when it came, would be huge. They increased their risk right when they should have been running for the hills.
So fast forward a few weeks. September 1998. How bad was it?
It was catastrophic. In just a few weeks, they lost something like $4.6 billion.
$4.6 billion on capital that started around, what, $1.25 billion?
Yeah. They were effectively wiped out. But the real nightmare wasn't just LTCM failing. It was who they were connected to.
Ah, the systemic risk aspect.
Exactly. They had trades, loans, derivatives, contracts. The total value of their positions was estimated at over $1.8 trillion.
Trillion. With a T.
With a T. And those contracts were with practically every major bank on Wall Street, in London, Frankfurt, everywhere.
So if LTCM went under, it wouldn't just disappear.
It could trigger a chain reaction, defaults cascading through the entire global financial system. It sounds traumatic, but the US financial system was genuinely on the brink.
Okay, so this leads to that big question, right? When genius fails that badly and brings the whole system close to the edge, who picks up the pieces? Who pays?
Well, that's where the Federal Reserve stepped in, specifically the New York Fed, led by William McDonough at the time. They saw the potential for meltdown.
So a government bailout, taxpayer money.
Actually, no, not directly. The Fed did something unprecedented. They basically strong-armed 14 of the biggest banks, LTCM's own counterparties, into funding a bailout themselves.
They got the banks to bail out the hedge fund.
Sort of. It was a $3.6 billion rescue package put up by the banks. But the crucial point the Fed made was, This isn't about saving LTCM or its rich partners.
It was about saving the system from LTCM,
Yeah.
preventing that global financial collapse.
Exactly, preventing contagion. It was maybe the first major instance of the too big to fail concept really playing out in practice, way before 2008.
And the irony, the
Yeah.
fund built on pure free market rational principles.
Gets saved by a coordinated, non-market intervention orchestrated by the central bank. The irony is thick, absolutely.
So after the bailout, what happened to LTCM? Did they recover?
No, the fund was wound down in an orderly way over the next year or so. The partners lost almost everything. There was no comeback story, just silence.
A very expensive, very humbling silence, I imagine, echoing through finance, academia.
Everywhere. It wasn't just a company failing. It felt like a whole philosophy took a massive hit. The idea that pure brain power makes you safe, that math can predict human fear.
Which brings us right back to the lessons learned. Or maybe the lessons they forgot.
Right. LTCM didn't fail because the people weren't smart. They were ridiculously smart, some of the smartest around.
They failed because they thought being smart was all that mattered.
That's a big part of it. Being smart wasn't enough.
Okay, so let's crystallize those takeaways for everyone listening. What should you take from this?
Well, first, I think, is that risk isn't always obvious. It's not always in the historical data. Models are great, but they can't predict panic. They can't predict irrationality or those black swan events. Markets have a psychological dimension that math struggles with.
Lesson 2 seems pretty clear. Leverage cuts both ways.
Oh yeah, it's rocket fuel on the way up, but it's pure poison on the way down. It magnifies everything. LTCM's tiny edges demanded huge scale, huge leverage, and that leverage became their Achilles heel.
Third takeaway. Even geniuses screw up. Big time.
Absolutely. Nobel Prizes, fancy degrees. None of it grants immunity from mistakes, especially when you mix in ego and maybe a blind spot for real-world messiness. They're still human.
Which leads to the last point, maybe the most important one. Humility.
Yes. Humility isn't just nice to have, it's a survival tool. The market ultimately doesn't care how smart you think you are. It doesn't care about your elegant formulas.
It runs on fear, greed, supply, demand, and just unexpected stuff happening.
And ego, especially when combined with that kind of leverage, becomes maybe the most dangerous force of all.
So LTCM, it really is this stark, powerful lesson about the limits of intellect against the unpredictable, sometimes irrational forces of the market and human behavior.
And the dangers hidden in complexity and interconnectedness.
So thinking about today, what does this story mean for you? We live in a world now that's even more driven by algorithms, AI, big data. How much faith should we put in these complex models?
Right. When do we trust the numbers, and when do we need to remember that unpredictable, messy human element that can just throw a wrench in the works?
What part of this story makes you think twice about risk or about what success really means?
It's a question that echoes far beyond just finance now, doesn't it? How much do we rely on the systems we build versus our own judgment or intuition?
Something to definitely mull over. Stay humble, stay aware.
And remember, even genius isn't foolproof.
Especially when the stakes are that high.
Hey listeners, if you enjoyed this podcast, don't forget to like and subscribe to our channel for more amazing content. And if you found value in this episode, share it with your friends. You never know who might need it today. Also, let us know in the comments if there's any of your favorite books you'd like us to review next. We'd love to hear from you.